Right now we're continuing to enjoy this period of below average defaults. And we've had three periods in the high yield market where defaults got really elevated. So you had the 1990-91 period around Drexel. You had the 2002-2003 period around the NASDAQ, Telecom, then meets WorldCom and Enron. And in each of those two scenarios, you flush a lot of the weaker companies. A lot of the weaker companies default. And what I think is interesting about that is once you purge that weaker cohort of the companies that default, historically you tend to have a pretty long period of below average defaults. In some cases 8 or 9 years post 91, 6, 7 years post 2002, 2003. We're only 3 years past the default peak. And given the health of corporate issuers, given kind of the way they're behaving, which is pretty conservatively, I think we have a period of below average defaults for a prolonged period of time here. So we're 3 years into the post-peak period, but I think there's a couple more years of run in that.
Yeah, and just to put some numbers on it, defaults peaked at just above 16% in 2009. They've come all the way down to below 2%, and it ticked up a little bit, but still hovering around 2%. And that's about half of the long-term average. So this credit improvement that Paul, has referred to, where companies have hoarded cash and they've seen a slow growth world, so they've been reluctant to spend a lot of money, reluctant to hire a lot of people, which we're well aware of. That's had the positive benefit of keeping balance sheets really good, and we think keeping default rates below their long-term averages well into the future.
There's a couple more even objective measures you could use to do that. One of the things you can think about, and people might debate the role of the rating agencies, but you've had meaningfully more upgrades and downgrades. You generally have cash balances on companies, balance sheets that you can look at. You can look at margins, you can look at cash flow growth versus debt. And those are all pointing in a fairly positive direction, kind of underscoring what we're talking about. So it's not just reliance on this kind of measurement in years from the peak, but you look at the companies and you go through the cohort of what we're financing right now, and it still feels like it's got pretty good durability.
Yeah, 3 years ago there were about $100 billion of bonds defaulting. And this year so far, I think we're at 8.9 or just under 9 billion of defaulted bonds. So there's far fewer. So defaults are not something that we're that worried about right now.
And it's interesting when you go back through it. One of the ways that you start running into problems in credit markets is as deals get a little more aggressive, and you start all of a sudden kind of stretching the string a little bit of credit quality. And we're still looking at almost 2/3 of issuances for refinancing. So it's for those companies that survived the 2008-2009 time period. So it's not as if we're seeing this big cohort of LBOs or really aggressive transactions, because that would be sowing the seeds for some problems. We're just not seeing that yet.
Yeah, and a related point I was just looking at is that back in 2007, pre the big wave of defaults, only about 10% of high yield bonds actually had hard assets as collateral. In the event the bonds defaulted, most of the bonds are unsecured. But because of the dislocation that we've seen in the loan market, through the cycle, many loans have been refinanced into the high yield bond market now that 25% of the high yield market are now secured bonds. So they have those very favorable first to get paid characteristics that leveraged loans have. So just adding to the thought that this cohort is very strong.
We have a lot of conversations right now because as we sit down here today, you're starting to talk about yields in the high yield market, depending on which benchmark you use, 6.5%, 6.75%, 7%. And a historic concept that doesn't feel like high yield, but nobody's running around going, okay, now we're in the moderate yield market. I think you have to think about it all on a relative basis. So you're looking at short rates that are still hovering around zero. You're looking at 5-year U.S. Treasury rates that are kind of in the 0.6% range. You're looking at kind of 10-year rates that are low. So on a relative basis, we keep going back to the spread proposition in high yield is still above average historically, and we think that the credit quality is quite good. So you think about that, and you think in a moderate growth environment, that should still be a pretty good time for high yield versus other asset classes. You can go at that two ways. It has less rate sensitivity and more yield than a lot of the safer government-oriented yield spaces, so I think that bodes well for it. And you get a lot of the improvement in corporate fundamentals, but you don't need growth the way the equity market arguably does. So I still think it's got a nice place in a portfolio allocation. We always go back to, if you look at the 25, 28-year period, you go back to the mid-'80s through most recently, high yield is almost as well as equities with about half the volatility, give or take. Go the most recent 12 years where we haven't had as much growth, it looks pretty good. And I think we're going to continue to see that kind of roll, kind of sandwich right in the middle between more rate-sensitive fixed income and equities.
To the extent we get higher rates, and that's reflective of more demand in the economy, that is a good kind of higher rate scenario. The companies that we are invested in, their liabilities are fixed, usually as a result of some event or a buyout. And to the extent that they can get some inflation in the value of their assets, they're able to grow their way, into their balance sheet, if you will. So a little bit of inflation, pricing power, and appreciation of their assets relative to a fixed debt burden can actually be a good thing.
And one of the things I think we've seen over the past 24 months is I think there's been a lot of money that's come into high yield, and that always makes you take a step back and say, what does that mean for the asset class? When we look at spreads that are still above average, we look at the quality of the companies we invest in, I think it might be a little bit of catch-up. I think if you go back to a lot of asset allocation models, people might argue the high yield market's been underappreciated for a lot of reasons we talk about. It's done very well versus equities versus with less volatility. So I think there's been a little bit of catch-up to that. I also think you've got this question of how are you going to determine how your portfolio does? Do you want to take a lot of rate risk? That doesn't feel great with prevailing yields and kind of the rate sensitivity. Or do you want to bet on a growing economy and equities? And there might be some people that say you don't need that much growth for equities to be attractive, but generally equity prices follow earnings growth. So I still think high yield's got a nice spot right there in the middle. You get the benefit of a moderate recovery, you get the benefit of all the improvement we've seen in balance sheets, but you don't quite have you're not as exposed to that move in rates that everybody thinks is somewhat inevitable.
And where we'd really get hurt is if growth actually slows and reverses, and we end up in another recession. That's not good for high yield companies. Obviously, that's why we continue to do what we've always done in the portfolio, which is maintain a very diversified portfolio relative to some of our peers, because it's very difficult at times to predict where the weakness will come from, and the prices of high yield bonds can be impacted more quickly sometimes than you can react. So that's why we have our big team of research analysts, 20 people here in Boston and London, and we're trying to find early signs of weakness either in the economy or a certain sector. Paul mentioned coal or a given company. And then we want to own manageable amounts of these companies so that we can trade around it.